Microfinance for agriculture has been and continues to be a difficult topic. On the one hand, there's a considerable potential to expand microfinance services outside of urban and peri-urban environments. On the other hand, there are many challenges trying to expand services into rural areas, and particularly to farmers. The first big problem, specifically with farmers, is that there's such a bad history in many developing countries concerning agricultural credit. For years, governments and financial institutions, particularly agricultural development banks, followed a policy of trying to push large amounts of cheap or subsidized credit into agriculture in order to increase food production, take advantage of the agricultural green revolution, and so on. In the process, however, many farmers got the notion that because the money was coming from a donor agency or from the government, it didn't have to be repaid. So even though the new technology might have been quite profitable, and perhaps the borrowers had plenty of capacity to repay, in many cases they chose not to. In many cases the debts were forgiven. So many of the microfinance institutions that now want to begin to serve agriculture find that their very first challenge must be to convince the farmers, convince the rural borrowers that this credit must be repaid, that this is serious. It's not government money, it's not donor money, it's not a gift. And changing attitudes sometimes is quite difficult. But in addition, there are several other attributes or characteristics of agriculture which makes it somewhat difficult to simply mimic in agricultural areas what is being done in urban areas. Rather, there has to be, in many cases, significant differences in lending methodologies and approaches and so on. Let me give you some examples. Number one has to do with the fact that the agricultural clients, the rural clients, are more geographically dispersed. One of the successes of urban microfinance has been due to the fact that there are a large number of low-income people concentrated in urban areas or peri-urban areas, and therefore the microfinance institution and the individual loan officers can serve quite a lot of clients. They can physically get to those clients and be quite efficient in the number of loans that they service, and this helps drive down the cost. In agriculture, in rural areas, clients usually are much further apart, they're much more dispersed, and therefore the costs are higher in order to reach those clients. A second feature of the agricultural sector, which tends to differ from most of the subsectors in which microfinance is typically servicing, has to do with the fact that agricultural producers oftentimes face an international market for their products. So therefore, the prices that farmers receive for their rice or their corn or for their wheat or their coffee or some other commodity fluctuates depending on world supply and demand. So therefore, that's unpredictable to them. Sometimes their profits may be quite good, sometimes their profits might be quite low, and therefore their ability to repay their loan depends on something beyond their control, depends on what happens in world markets. Thirdly, the profits of agriculture generally, this is anywhere in the world, tend to be rather low compared to prices for other commodities. In the microfinance area, for example, the small trader, the small shopkeeper, what have you, oftentimes has a very special location, so it's possible for them to set their prices at a reasonably high level, and the local consumers will still go there and shop there, be their customers, because it's very convenient for them. And therefore, the profit margins for the clients, that is the shopkeeper, tend to be fairly reasonable, so they can pay the relatively high interest rates that the microfinance institution must charge. Farmers, on the other hand, oftentimes work with fairly low profit margins and therefore their ability to pay high interest rates is somewhat limited. Another problem for the microfinance institution and for the farmer is the seasonality of agriculture. This means that in the springtime there are many customers that want to borrow. So the loan officer has a lot of work to go out in a short period of time, find many customers, meet with them, do loan appraisals, make decisions about whether or not loans should be made, what size loans to be made, help with the disbursement of the money, and so on. And then the growing season comes along and there's much less work to do. Then there's the harvest season. Farmers sell their commodity, so then there's a big task of going out and collecting on the payments and so on. It also means then that at one time of the year the microfinance institution has to have a lot of money to disperse, and then there's another time of the year that it has a lot of money coming back in. So the management, the financial management of the microfinance institution is much more complicated as compared to urban microfinance, where they're making loans all year round, getting recoveries all year round, and so on. The risk of agriculture represent another problem. Of course, there are risks of various kinds dealing with urban clients, but agriculture has some additional ones. There's the problem of the production risks that the farmers face. Droughts, floods, disease infestations, insect infestations, and so on. That can, in some years, produce a very good crop, and other years produce a very poor crop. There's also the marketing challenge. Sometimes there's a limited supply of product in the marketplace, so the traders are chasing after farmers, wanting to get their produce, paying reasonably high prices. Other times, prices are very low. There's an abundance of products. Farmers can hardly find anybody to sell to. And when they do sell, then may get a low price. Now, there's some urban microfinance customers that face some of those same problems, but usually it's not so serious. And many of the urban clients of microfinance institutions are engaged in a whole wide variety of activities. So if one subsector runs into some particular problems, and maybe those clients have some difficulties repaying, there's clients that are working in all kinds of other subsectors that are doing quite well, and they don't face those difficulties. So we have a number of challenges, a number of difficulties, which imply that although we can use a number of microfinance principles, we oftentimes have to make adjustments to them.